Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Amira Nabila binti Cik Omar, and today I'm going to present about executive summary of subprime crisis. When the subprime mortgage market collapsed in late 2006, it set off a chain of economic and financial crises that swept through global financial markets, resulting in a housing market decline and placing the US economy on the verge of collapse. As a result, many in the ANC and the executive branch have proposed new government spending plans and measures that would significantly increase the government's participation in the economy while doing little to alleviate the financial difficulties that have spread rapidly across virtually every sector. The current global debt crisis is the result of difficulties in the US subprime mortgage sector. Until the end of the millennium, loans were mainly made to creditors with a good credit history who met the requirements for the registration of state-funded institutions. These loans are called parallel loans. Subprime loans, on the other hand, have significantly increased their market share. Subprime borrowers are those with a poor credit history.
Assalamualaikum warahmatullahi wabarakatuh. We are required to present about subprime crisis. Before we start, I would like to introduce our group member. So, my name is Nid Nuratillah Liana binti Nidli. The others member will introduce themselves by own video present. So, I want to explain you about subprime crisis. What's the subprime crisis? Subprime crisis will be restricted within the realm of mortgage issue who had overloaded on subprime loan as recently as May 2007. For example, when banks sold too many mortgages to fit the demand for mortgage-backed securities sold through the secondary market 2007. Next, the subprime effect would be as severe as it has been thus far, posing a serious threat to the economy. Refers to the borrower or loans with weak credit score that are typically given at rates significantly above prime. Loans on US mortgage-backed securities, or recalled as MBS, backed by subprime mortgage, began to extend to other sectors. There are three markets, such as loan market, interbank lending market, and commercial paper market. Loan market is a market where financial organizations provide loans to borrowers and sometimes repackage them. For the interbank lending market, known as a global network that allows financial institutions to directly trade currencies and other currency derivatives. For example, banks use the interbank market to manage their own exchange rate and interest rate risk, as well as to take research-based speculative bets. Lastly is a commercial paper market, known as money market asset issued by large organizations to cover short-term debt commitments such as payroll. To better understand the pledge of the issue bank or company to pay the upfront amount on the maturity date specified on the notes.
Hi, my name is Nur Hafiza and I will continue with chronology of subprime crisis. The subprime crisis occurred when the bank sold too many mortgages to fit the demand for mortgage-backed securities sold through the secondary market. When home prices fell in 2006, it is triggered default. The risk spread into mutual funds, pension funds, and corporations who own the derivative. Here is the timeline from the early warning sign in 2003 to the collapse of housing market in late 2006. It started on 21st February 2003, where Buffett warned the financial weapon of mass destruction. The first warning of the danger the mortgage-backed securities and other derivatives came on February 21st, 2003. That's when Warren Buffett wrote to his shareholder about financial weapon of the mass destruction. And then, on June 2004 until June 2006, the Fed started to raise the interest rates. By June 2004, housing prices were skyrocketing. The Federal Reserve Chairman started to raising interest rate to cool off the overheated market. Disastrously, the raised monthly payment for those who had interest only and other subprime loans based on the Fed fund rates. Many homeowners who could not afford conventional mortgage took interest-only loan as they provided lower monthly payment. When home prices fell, many found their homes were no longer worth that they paid for them. As a result, these homeowners could not pay their mortgage nor sell their home for a profit. On the August, International Monetary Fund economists warned the world central banker, which is Dr. Raghuram Rajan, was the chief economist at the World Bank in 2005. Dr. Rajan's research found that many banks were holding derivatives to boost their own profit margin. And then, on December 22, 2005, the yield curve inverts. Right after Rajan's announcement, investors started buying more treasury, pushing yields down, but they were buying more long-term treasury, maturing between 3 to 20 years than short-term bills. This means that investors were investing more heavily in the long term. The high demand drove down the return. Why? Because they believed a recession could occur in 2 years. Furthermore, on September 25, 2006, the home prices fall for the first time in 11 years. The National Association of Realtors reported that the median prices of existing home sales fell prior the year. That was the largest decline in 11 years. Prices fell because the unsold inventory higher prior the year. That was almost double in the 4 months supply in 2004. And most economists thought it just meant the housing market was cooling off, though that because the interest rates were reasonably low. And then, on the November 2006, the home permit fell 28%, which is the slowing demand for the housing reduced new home permits 28% from the years before. These leading economic indicators came in at 1.57 million. New home permit issued about 6 months before the construction finishes and the mortgage closes. This means that the permits are leading indicator if new home closes. Interest-only loans made a lot of subprime mortgage possible, and homeowners were only paying for the interest and never paying the down principal. That was fine until the interest rate kicker raised monthly payment as housing prices started to fall. Many homeowners found they could no longer afford to sell their home either. Voila! Subprime crisis mortgage such a mess. And lastly, how the subprime crisis created in the 2000 banking crisis. As home prices fell, bankers lost trust in each other. They were afraid to lend each other because if they could receive mortgage backup securities as collateral, once home prices start falling, they could not price the value of this asset. But banks do not lend to each other. The whole financial system started to collapse.
The first cause of subprime crisis is credit rating firms and MBS sponsors are at odds over profits. Under the Investment Company Act of 1940, a trust or issuer of mortgage-backed bonds may be designated as an investment company and thus be subject to broader limitations of the Act, such as Battle, Farrell and Hutchinson in 2008. They issue fixed income securities and have 4 very high ratings from a nationally recognized employee rating center. May be eligible for exemptions from the Act like S&P, Moody's and Fitch. The arrangement stated above has the potential to generate a conflict of interest between credit rating agencies and MBS trustees who set up trusts or issues and have the authority to request an exemption from the 1940 Act based on the rating firm's criteria. Although the quarterly revenue from fixed shares increased in the first half of 2001, its quarter revenue from fixed shares, including MBS securities, was slightly larger than the corporate mortgage, also including MBS securities, was almost 3 times more than business securities. The second cause of subprime crisis is conflict of interest between the credit rating agencies and the investment manager mortgage. Rating firms usually evaluate mortgage-based bonds using the same rating system as corporate bonds. The continuous flow of active data has shown that business bond measurement is widely known. It has been around for about 100 years. Evaluating agencies are required to publish their ratings. Credit rating agencies must make public policy terms and conditions of securities based on purchases public. However, the complexity of and transparency of the models used by rating agencies raise concerns. The third cause of subprime crisis is conflict of interest between the homeowner and the lender. This was based on Mian and Sufi case in 2008, which is a relationship between homeowner and the lender. They reported a sharp increase in the amount of loans sold by loan holders shortly after leaving non-collateral institution between 2001 and 2005. They refer to the aforementioned cracks in which credit cards makers sell loans as soon as they are done. These non-collateral corporations, as noted earlier, put these financial houses and evicted investors from mortgage-funded mortgage institutions. As a result, lending to a real estate agent or lender has increased dramatically. The home developer or lender receives points and closing fees paid by the homeowner as well as any premiums earned through the sale of a loan to an MBS sponsor.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Atira binti Rizam. So I will present about the effect of subprime crisis. So there are two effects that I found out, which is housing market and yield curve effect. So what's included in the housing market? So housing market means housing price are reduced, which is we can see in the US. In United States give out loans with the very low of interest rate. The central banks in the United States give out loans with the very low of interest rate. It is because the housing price at the United States reduced effect of the crisis and the counter deflations that happened in the United States. So from the amount of interest rate 6.5% in May on year 2000 become 1.0% in June on year 2003. When this happened, people will motivate to invest in house as real estate was marked as a safe investment for future. So this low interest that they get will be the incentive for people to remortgage their house loans through longer repayment period to reduce the high monthly of repayment of loan. So the percentage is quite large for the new mortgage, which is it called as a subprime. Central bank will focus on the individual that comes with the low of credit ratings. It will give the benefit to the borrower of loans, but it will give the bad effect to the borrower because the chance of foreclosure and frequent mortgage is high. Effect for the bank is they were unable to recover the loan amount from the borrower because the amount of the borrower become huge drastically. So we go to the next effect, which is yield curve inverse. So yield curve United States Treasury inverted. Why? The investor made the option to choose the long-term treasury that matched between 3 to 20 years because they will get the more benefit on it. When it happened, the yield on long-term treasury was falling faster than the short-term treasury notes. On 2005, the yield curve of United States Treasury inverted, which is from 4.39% in 7 years become 4.40% drastically because of this crisis. To get the 1% is too high, but when this crisis happens, its effect to the economic and the bank Before this, the yield of the long-term treasury notes falling faster than the short treasury notes. But when this crisis happened, the yield of long-term treasury notes not rising fast. The investor made smart decision when they know about the economic and yield curve, in fact causing them to make the choice to prefer the long-term treasury note than short-term treasury notes. For the bank, it will give the back effect, which is the demand of long-term treasury notes higher than short-term treasury notes, and the effect to the bank, they will get the low yield returns. For the investor, it will give the good effect, which is they can get the high returns to offset the difficult of the investment environment that they anticipate will occur in 2007. The investor made the right options on 2005 because on 2007 the subprime mortgage crisis became worse in the United States, and it involved all banks around the world. Between bankers lost trust in each other. At the same time, they afraid to lend to each other because the collateral just only mortgage back. When the home price fall, the bankers can't state the value of this asset that be the collateral. So that's all from me. Thank you. I will pass this presentation to the next presenter.
As we explained earlier, there are many causes of the subprime crisis. So how did they manage to overcome this crisis? To address this problem, government and businesses are working together to create creative solutions to reduce eviction and aid the recovery process. The solution is that the Federal Home Loan Bank system was designed after the Federal Reserve, a group of real estate appraisers who wants to make their profession more professional, reform to the bankruptcy law that allow ordinary people to seek protection from the creditors, the formation of several beneficial organizations including Homeowner Loan Corporation, the Federal Housing Administration, the Federal Deposit Insurance Corporation, the Security and Exchange Commission, and the Federal National Mortgage Association. The subprime crisis requires changes on the same scale, including a number of measures for which bailout, financial information infrastructure, and new institutions are necessary. What is bailout? A bailout is when a business, an individual, or a government provided money or resources to a failing company. This action helps to prevent the consequences of that business's potential downfall, which may include bankruptcy and default on its financial obligation. To avoid or reduce future bubbles, the United States needs a new financial information infrastructure. This should involve the creation of new risk management markets, such as the real estate derivative markets. Investors can now buy the real estate future contracts, but they are not very liquid. The banking sector should provide continuous exercise mortgages with payment schedule that respond to market fluctuation and personal income. The government should support financial advice in the same way as subsidizing medical advice. Currently, high-income individuals get tax relief when they buy financial advice, but low-income people who probably need it most get nothing. The entire subprime disaster may have been avoided if those on low incomes had been given access to sound financial advisor before signing up for subprime loan. During the Great Recession, the Homeowner Lending Corporation or HOLC issued loan to mortgage lender and used their anxiety mortgage as collateral. On the other hand, the HOLC stipulated this mortgage must meet specific standards for safe and responsible loan. A monitoring organization similar to the Consumer Product Safety Commission is also required in the United States to ensure that careless or exploitative financial institutions do not market unsafe financial products
to naive customers.
We go to conclusion. So we can conclude that there are exceptions, chronology, causes, impact, and solution of the subprime crisis. Many analysts predicted that the problem would be contained to mortgage issue who had become overly reliant on subprime lending. One of the numerous representations of the subprime crisis on the economy is the inversion of the yield curve in the United States. So, for the solution that the US has come up with to deal with the situation, the government and business collaborate to create creative solutions to reduce evasion and aid the recovery process. The subprime mortgage crisis at United States may be the worst financial calamity such as depression. As a result, the solution for this crisis should not be to go back in time and punish technology and market, such as to reduce risk, promote economic justice, set the foundation for a more secure and equitable financial system in the future.